The global auto industry is undergoing a fundamental realignment. Right now, as we're looking at the data from September 2025, a powerful trend has emerged, one we're calling the Great Divergence. It's a clear split between the winners and the losers of this electric transition, and the data behind it is, well, it's striking. Let's get into it.
So, what is this great divergence? Well, here's our core thesis. Capital, big capital, is making a very clear choice. It's flowing decisively toward a new class of leaders, especially in China's new energy vehicle, or NEV, sector. And at the exact same time, it's pulling away from many of the world's established automotive giants. Look, this isn't just about going electric anymore. What we're seeing is a fundamental repricing of what matters: technology, strategy, and global ambition.
Okay, before we dive deep, here are the 4 key takeaways from our analysis. First, the Hong Kong market has become the new global growth engine for this industry. Second, value creation is shifting, and shifting decisively towards Chinese NEV leaders. Third, that valuation gap between the disruptors and the old guard, it's getting wider. And finally, we'll see that the market is rewarding one thing above all else: strategic clarity.
So here's our roadmap. We'll start by defining the divergence, then compare 3 key markets to see it in action. After that, we'll get into the specific winners and losers, decode that huge valuation gap, and finally, we'll look at the key trends shaping this new automotive order.
All right, let's begin. At its heart, the story of 2025 is really about a massive reallocation of capital. Investor confidence is shifting, and it's redrawing the entire map of the auto industry. And to see just how stark this is, we've got to compare the world's key markets.
So let's pull back and look at the macro picture. When you compare the performance of the 3 major automotive capital markets, that's the US, mainland China's A-shares, and Hong Kong, a really fascinating story starts to unfold.
And here it is, in one chart. This really shows the divergence in black and white. Year to date, the market cap of auto companies listed in Hong Kong has just soared by 69%. Now compare that to the US market, which had a very respectable 49% gain. But then look at mainland China's A-share market at only 15% growth. I mean, this isn't a subtle trend. It's a massive signal about where global capital believes the future is headed.
So, the big question is, why Hong Kong? What's going on there? Well, it's become the epicenter for one simple reason. It's the primary gateway for international investors to get direct access to China's most dynamic, export-focused NEV companies. We're talking about names like BYD, NIO, and XPeng. Because it's the main offshore hub for this new automotive vanguard, its performance has become a critical barometer for global confidence in the sector.
Okay, so we've seen the macro picture. Now let's drill down to the company level, because this is where the divergence gets even more pronounced.
Just look at this table. The contrast is wow. On one side, you've got staggering year-over-year growth. Tesla's up 78%, and then you have the Chinese automaker Seres up an incredible 105%. But then look at the other side. You've got incumbents struggling. Great Wall Motor is down 14%. A legacy giant like Stellantis, down 34%. The market is absolutely making its choices clear.
So let's make this even more concrete with a perfect example, a tale of 2 Chinese automakers. First, you have Seres. Its value has more than doubled. Why? Well, it's not just about the cars they make. It's about their deep tech partnership with Huawei. The market sees Seres as a proxy for Huawei's own massive auto ambitions. Then, in sharp contrast, you have Great Wall Motor. Its value has fallen, and that's a direct reflection of the market's concern about the delays and challenges it's facing in its own NEV transition.
But, it's not just a simple story of new disruptors versus old dinosaurs. There's a really important twist here. With the slowdown in pure EV adoption in some Western markets, hybrid technology is suddenly making a big comeback. For legacy automakers, think Toyota, GM, Ford, this is proving to be a lifeline. Their deep expertise in hybrids is actually boosting profitability and, crucially, buying them time. And that's something the market is starting to reward.
Okay, this brings us to the really big question. How do we decode this massive valuation gap? I mean, why is one company valued so much higher than another, even when their profits today might look similar? It all comes down to one thing: expectations for the future.
And these valuation multiples tell that story in numbers. Let's start with Tesla. It's trading at a price-to-earnings ratio of 208. The market is clearly not valuing it as a car company, but as a tech company. Series is at 48, which signals tech-enabled growth. Now, shift your eyes to the incumbents. Toyota, a massive, successful company, trades at a PE of 8. And then there's Stellantis, with a PE of just 5, and a price-to-book ratio of 0.3. Think about that. The market is valuing the entire company at just 30% of the stated value of its assets.
Let's just pause on this number for a second. 28 times earnings? To be absolutely clear, the market isn't valuing Tesla on the cars it's selling right now. It's paying a massive premium for what it believes is its future potential in AI and robotics and energy. This isn't the valuation of a car company. It's the valuation of a tech giant.
And now for the complete opposite end of the spectrum, 0.3 times book value. This is the other side of that valuation chasm. What the market is signaling here is deep concern about the future of Stellantis' assets. It's the classic fear of a value trap, a company that looks cheap on paper, but might just be cheap for a very good reason.
So when you put it all together, here's the crucial takeaway. This isn't just a valuation gap, it's a strategic clarity gap. The market is paying the highest premiums to companies that have a clear, credible, and compelling story about their future, a future built on tech, on software, and on global expansion. And what about uncertainty? Well, right now, uncertainty is being punished and punished heavily. Okay, so let's zoom out again and look at the key strategic trends that are actually driving these massive shifts we're seeing across the industry.
To really get what's happening, you have to understand the landscape in China, which is now the world's most important auto market. And it is not a monolith. You can really break it down into 4 distinct types of players. You have the private enterprises like BYD and Geely driving innovation. You have the tech-first new forces like NIO and XPeng. Then there are the massive state-owned giants that are trying to transform. And finally, you have this new, really interesting category, Gen 2 spin-offs, these agile NEV brands that are backed by the deep pockets of those giants. And all of these players are competing across 3 critical battlegrounds. The first is domestic versus global. Just look at BYD. Its domestic sales actually dipped slightly, which is rare, but its exports surged over 100%. That tells you globalization is the new growth story. The second battleground is pure EV versus hybrid, especially with that hybrid revival we talked about. And the third, and maybe most important, is technology leadership. A company like XPeng, for instance. Its high valuation is directly tied to the success of its advanced driver assistance system, which has a staggering 83% adoption rate among its city users. That's a powerful data point.
So what does all of this add up to? Let's distill this entire analysis down to the key takeaways that really define this new automotive order.
Looking at all the data, 3 core themes really stand out. First, the globalization of Chinese NEVs is, without a doubt, the dominant growth narrative right now. Second, technology is the ultimate differentiator. We're talking about clear advantages in software, autonomous driving, or unique business models. That's what commands a premium. And third, there is a turnaround play for some of these undervalued traditional automakers, but it's a high-risk, high-reward scenario that hinges completely on executing a successful and, most importantly, profitable hybrid strategy.
So the outlook here is pretty unambiguous. This great divergence we've been talking about, this split between the new leaders and the old guard, it is not a temporary blip. We expect this to continue until, and this is the key, until legacy automakers can demonstrate to the market that they have a clear, a credible, and above all, a profitable path forward.
And all of this leaves us with one final crucial question. You know, for the last 100 years, the answer to this was obvious. But looking at the data today, you have to ask, in the decade to come, who will truly define what an automobile is? Will it be a car company? Or will it be a technology company?
That concludes our analysis. Thank you for joining us.